recording is about the statement of cash flow. It's the fourth financial statement that a company will issue, and there actually are only four, so it's the last one we're going to look at. When we looked at this demonstration problem in class, we actually sketched out cash coming in and cash going out of the bank for a particular company. That's very informative information. So we're actually going to prepare a financial statement showing the cash coming in and the cash going out. Or in other words, the cash that flows in and the cash that flows out. That's why it's called the cash flow statement. So it's pretty basic. And then when I go over here and look at, the statement of cash flow, all we're showing essentially are deposits, cash coming in, so money we're going to deposit in the bank, and cash going out, which would essentially be the checks that we write. But it gets more complicated because we categorize those in three categories. So let's go look at, what are those three categories going to look like? Well, actually, the three categories are just based on a very basic business model. And so it really just looks at, if we were starting a business of our own, we would need money to buy our assets. Let's say that we're starting and we're going to open up a candy store. Well, I'd actually need a building for the store, and I probably might want a truck, a van of some sort, to help me carry supplies and that sort of thing around. Well, I probably wouldn't have enough money on my own to afford that. So I need some money or cash to get started. Well, one place of getting started then of raising money is I could borrow it. So we would incur debt then. So I would borrow from a bank or some sort of financial institution. Those folks are referred to as creditors. So I can go to a bank who is a creditor to me and borrow money. If we're a business, we also have the opportunity of sharing ownership rights. So if we form a corporation, we could issue stock, sell that stock, get cash, and issue shares of stock which represent ownership rights. We would sell stock to our investors, which are also then in a corporation become owners, so investor owners. Now if we're a partnership, they would be partners instead of shareholders. So the money would come in. So we would either borrow money or issue stock in order to receive cash. Cash will come in that allows us to buy these assets. And then we're going to use these assets to generate sales. And sales then is our revenue. If we provide the candy, we sell the candy, that's revenue. So we incur revenue, and it could be selling a product, it could also be delivering services, so goods and services, either one, generates revenue. And of course we also know from studying the income statement now that we're going to incur costs, expenses. We will use expenses in order to generate those sales revenue. And of course that's going to net and result in profits or net income. So we have sales, we incur our expenses, hopefully we'll end up with a net profit or net income. If we're profitable, that will satisfy these investors and creditors. Now what the accountant will do is come in, and you can see I've made three areas here. The accountant is going to label borrowing money and issuing stock as financing activity. So we finance with debt and equity. Then we take the cash from borrowing or issuing stock and invest, we purchase the assets, so we invest in the assets. So buying the assets is considered investing activity. But the core activity is over here, isn't it? It's selling the candy. It's incurring these expenses. So the large activity of the business is in its operations. So all of this sales and incurring these expenses are operating activities. So we can go up here. Here's a framework of our cash flow statement. We're going to see those three. Operating gets listed first because that's the core activity of a business. Then we're going to list our activities with our long-term assets, the investing activities, and then the financing cash flows. So we're going to have cash coming in from each of these three. Let me summarize it again over here. So here's our three activities. So any cash coming in or going out that has to do with long-term assets like our building, long-term meaning assets that will be around for years and years, That cash coming in or out is investing. Financing transactions are transactions with liabilities and stockholders' equity. So again, that's transactions with our creditors and our investor owners. Just to be an E there, our investors. And lastly, operating activity comes from cash coming in from revenue and cash being spent for expenses. And we've talked about in class how revenue is not cash. Revenue is when I provide the goods and services, but it will result in cash being collected. Likewise, expenses, by definition, expenses when I consume a cost. But if I consume a cost, I actually have to pay cash for that. So that's the second. So expenses cause us to pay cash. Revenue cause cash to come in for us. Okay, knowing those three things, let's go over here and go to our demonstration problem, and let's identify the categories. And I'm just going to abbreviate them. So the first one was cash coming in from issuing stock. Well, that's with our shareholders. So that is a financing activity. I'll just abbreviate it. Also, we borrowed money from the bank, which is a creditor. That makes that a financing activity. So let's take this $25,000 and the $10,000, and we're going to go over here in the investing section, and I'm going to write that in. Okay, so we can see then that I have written issuance of common stock, $25,000, and issuance of note payable, $10,000. Okay, let's go back and look at the additional information. So we have purchase of bus equipment, so buying long-term assets that will be around for quite a while is an investing activity. Also purchase hockey equipment, that's an investing activity. Since both of those are purchase of equipment, I'm going to add those together, right, the $12,000 and the $1,500, and we have total cash paid of $13,500. And I put brackets around it because it's a negative number. So we've got an investing activity, purchase equipment. Let's go over here under investing activities and write that in. Okay, so I listed out purchase of equipment and I put brackets around the $13,500. Let's keep going back. Let's look at the next one. Cash came in because we collected tuition from customers. Remember, that was from, that was the cash collected from revenue from the camp. So cash received from revenue type activities is an operating activity. Now we also have, the next ones are going to be cash going out, so I'm going to stop. We're going to go over to cash flow statement, and in the operating activities, I'm going to write that in. Okay, so here's what it's going to look like. Cash receipts from operating activities. I didn't have enough room to write operating fully, so I just abbreviated OP with a period, but it's cash receipts from operating activities, and I put the $80,000 right there. Okay, let's go back and look at what we have remaining. We have 4 here that actually, remember, all 4 of these were expenses. So we had cash paid for rent used, which was cash paid for rent expense. We had cash paid for insurance used, which is insurance expense. And we had cash that was paid for salaries that were used, which was a salary expense. And cash paid for supplies purchased and used. So because all the supplies were used up, it was an expense. Those are all operating cash payments. So all 4 of these were cash paid for operating activities. And if I add those up, I'll get $47,000. And again, it's a cash payment. Those are cash payments totaling $47,000. So let's go over to our cash flow statement. And under operating activities, okay, now you can see I have cash payments for operating activities, and I have the negative $47,000. There was one more cash flow, right? We had a check written for $5,000, dividends paid to shareholders. Let's review over here. Cash received or paid to creditors or investors is financing. So dividends are distribution of profits to the owner investors. So that makes it a financing activity. So here's the last one. It's a financing activity for $5,000. So we're going to report that right there. Okay, so I have dividends paid, $5,000 negative. So we have our three categories: operating, investing, and financing. Now we're going to net each of those into the right-hand column. 80 minus 47 gives us cash provided from operating activities, $33,000. There was only one investing activity, so it's going to net to itself $13,500. I will point out, though, please notice when it was a positive number, the wording was cash provided by operating activities, and when it was a negative cash flow, it's the using of cash. And then the financing activities, 25 plus 10 minus 5 gives us a positive $30,000. So that gives us cash provided by financing activities to be $30,000. So we end up with our net 3, right? We net out the 3, and then we're going to sum those. So we've got a positive cash flow of $49,500. Then we're going to add that to the balance of cash at the beginning. Since this was the first year of operations, we didn't have any cash in the bank. So then our ending cash in the bank is $49,500. Now that's at the end of the period. Well, the balance sheet reports assets as of the end of the accounting period. So when we go to the balance sheet and look at assets, we should see $49,500 as the balance in cash. Let's go take a quick peek. And yes, here's our assets. We had cash in the bank, $49,500. Right there, $49,500. So that's that cash in the bank on the balance sheet under assets should agree to this right here. Okay, that's the cash flow statement.